Okay, back to deferred revenue. So it's not really a debt. It's something, yes, it's something they owe, but it's not like they're going to have to cut a check for it. They're going to have to cut a check for the teacher to teach the class, yes, and for the supplies in the class, but they're not going to have to pay this out unless they don't deliver. And there's no reason to believe that they're not going to be delivering their classes in the next year and they have to refund the money. So this isn't really a debt. Maybe you could cut this in half based upon their gross margin and say, yes, they're going to owe half of this. Their gross margin, when we looked up here, is about 41%. So probably about 41% of that is actually something that they're going to owe down the road. So they have a trade-off. They can either spend that money or refund this, and so I'm pretty sure they're gonna deliver on the class. So this isn't really a debt, so I'm not as concerned about that. Payables seem in line with receivables. I'm okay with that. I am just a little bit concerned how high this debt load is, given their asset base. But again, as we said before, if you looked at their free cash flow compared to this number, they don't need a lot of assets to teach these courses. If you look up here in the income statement, which we're going to get into now, if you look at their revenues, $1.2 billion. So they're doing revenue of $1.2 billion on this asset base down here, which mostly comprises cash, which will cover those deferred revenues pretty well, and a very tiny fixed asset base, almost 7-8 times their asset base in revenue. So they're really just churning cash flow through to the shareholders, really, and that debt load seems really tiny compared to what they have to spend on a regular basis to do it. So that debt to equity ratio can be a little bit misleading out there. So we went through the liabilities here, and it's high, and I'm a little concerned, but I can get around it just a little bit, just on the nature of the business. I would just be a little bit careful. This 140-150 number, if I start to see this long-term debt number start to grow, I'd start to get a little bit more concerned. But given that they've just been pretty steady Eddie on that, I'm okay. What about the income statement again? We're going to go back up here. How's revenue been doing over time? So I said they were around in the 40s. How's revenue been doing over the last 10 years? And it's just been pretty much growth here, growth. And then we start to see this dip. So when we looked at these charts, it kind of reflects the same kind of story as revenue. We're looking at everything. We're looking at peaks in 2010 and then drop. Peak in 2010 and then drop. If we keep coming up through here, see peak in net profit margin and drop. Peak in return on assets and drop. Return on equity up really high and then a drop. Even so, these really high numbers, everything seems to have that same trend, and it's all driven by revenue. That's true, obviously, in any business, but it's much more volatile in this business because it's very low fixed assets. So we can see revenue jumps up in 2010 and then drops. So what happened in this time period that would cause their revenues just to explode, really? I mean, you go from $1 billion in revenue to $1.5 billion in 2 years. What happened? A lot of people went back to school for re-education at this time. In 2008, the market crashed, unemployment shot through the roof, so people said, well, what do I do to get back into the job market? How do I find work? Well, I'm going to go back to school and get the skills to get a new and better job and improve my lot in life. So we can see that it kind of has a negative correlation between what the economy as a whole was doing, because people use these services to obtain income, so they are going to cash in on these services when they are unemployed. When you have a full-time job, it's kind of tough to go back to school. So now that people are out of work, revenue shoots up, and now as the market starts to improve, revenue is coming back down here. So SG&A seems to be kind of in line with everything else. The percentages seem to be a little in the high 20s, pretty steady there. They're keeping that in line, except for in 2012, all of a sudden it spiked up a little bit. So we have a little bit of a concern there that this is happening. Depreciation expense, pretty normalized. Not much has changed there. That's just pretty steady, based upon their assets and their buildings they need to depreciate. No big deal there. Interest expense, that's pretty paltry, compared to their revenues here. $1.2 billion, they've got $3.7 million in interest. No big deal. And in fact, it's even lower if you net these two out. In fact, they were making money in interest income. They were an interest positive business because they're getting these deferred revenues from their students. They're able to earn interest on that. So it's a little bit extra income they get out there from these prepaid tuition, which is nice. And then some other income in there, which seems to be small. Their tax rate's pretty high. They're paying 39% tax brackets. That's in line. There's no funny tax advantage that they're getting out there. They're paying their full freight on taxes as well. So we can see that this is probably pretty reflective of what they're showing the IRS too. So let's go down to cash flow and see how that's doing. So when we look at cash flow just grew, and then in 2010 it was ridiculously high, $558 million, and it's come back down. So it's in line with everything else. We can see here 2009 we have a big jump in receivables. So even though we had a lot of income, our receivables increased also at this time, and you can see the same thing happen here in 2012. Is this a concern, or is this a signal of growth? That kids are not paying, are students defaulting on their payments to them, on their tuition, or are they delaying payments? It's going to hurt cash flow. I'm not too concerned about this right now because ITT Tech has all the power in this regard. A student who wants a degree is going to have to pay their bill. ITT Tech can withhold the allocation of the credential, which is really what a lot of these people are driving for, is that piece of paper saying, yes, I've got this degree. ITT Tech can hold that until they get paid. So they have a lot of leverage out there on their receivables, which is a good thing. The concern would be that a lot of people are enrolling in these courses and then dropping out and not paying the bill. So a lot of that revenue they're booking up here may never happen. So that might be a concern here, but not too bad. We go through here, operating activities. So we see operating activities. All of a sudden, cash flow really just tanked this year. So what happened here? Net income was obviously the biggest driver here that this dropped, and this change in receivables here that we just talked about are the big drivers for why income dropped. So it really comes down to a question based on what we're seeing. Everything was going great from 2003 all the way up to 2010. Things were going awesome. They were doing great. Everybody was growing. People were going there. They were making all kinds of money. Everything was right with the world. And then 2011, things kind of slid a little bit. 2012, everything kind of fell off a cliff. It seems like all their metrics just kind of went by the wayside. What happened here? I'm really concerned about this just drop. Is this just something that just happened one time? Is this just a 1 year blip on the radar that they just had a really bad year, or is this going to be something that's going to be a long time trend? That I'm going to speculate that this will be a long-term trend. When we talk about qualitative analysis, I think this drop here is significant, and I think that this is going to stabilize around this area. That there is going to be a drop from 2010. We're not going to see these 2010 levels in the near future, or for the foreseeable future. That's my opinion of where I see them going long term. So even with that, do we still like to value the business based upon seeing this downward trend? Do we like them as a long-term value investment play, or are we seeing this as a value trap that we're going to overpay for a declining business? Is this one of those best buggy whip makers out there? They may last the longest, but they're still going to go out of business. We'll talk about that. Let's look at investing activities. Really no capex to speak of. I mean, it's tiny. What really do they need to spend money on? They have the building, they have the facilities. Really all they got to do really is upgrade some computers every once in a while, and maybe change around or remodel a classroom. There's not a whole lot of capex in this business, which is good. They don't have a lot to maintain. Once they have the asset, they can utilize that asset over and over again without wearing it down, which is a nice thing to have, that this capex is so low. They're purchasing some long-term investments that they had sitting out there, and they're also purchasing some short-term investments as well. So they're spending their cash on a lot of short-term and long-term investments, it looks like. So all this positive cash flow is going into some sort of investments. They're not paying it out to the shareholders quite as much. It seems like they're purchasing these investments. But when we go down here and we look at financing activities, they are buying back stock. They are buyers of their own shares. They have continually repurchased their stock from the shareholders. They haven't paid a dividend, so they're rewarding their shareholders with stock buybacks, and those stock buybacks have been continuous. It's kind of crazy here as you look at 340 million, 234 million that they bought, 339 million they bought, 427 million they bought in shares. Add this all up, they've bought, since 2003, they've bought $1.9 billion worth of stock for the shareholders. The problem is, if you look at their market cap today, it's at $300 million. So they've spent over 6 times today's market cap buying shares back. That's some poor investing right there. They've not rewarded the shareholders in that regard by buying back shares. They made some poor investments. They've probably been better off issuing a dividend here instead of repurchasing the shares. So they've been buying at the highs, but they've been buying continuously, and we shouldn't expect them to stop buying back shares unless we think there's danger that they're going to have cash flow issues later. If we think that they're going to remain stable and these numbers are going to stay the same, obviously they're going to continue to buy back shares if they keep their plan in place, and those shares are now currently cheap. So do you want to be in now while the shares are really cheap? I think that's a good place to be. So the question is, are they going to be a long-term company that's going to be around a long time and be able to repurchase our shares and reward us as shareholders? That's going to be the big question when we talk about the qualitative piece. Okay, so we go down here and we look at free cash flow. Been positive all those years, total free cash flow. Again, it looks exactly the same. We saw the chart earlier. But look at owners' earnings, significantly higher than our free cash flow. It's in the last 5 years, very much higher. $471 million in owners' earnings free cash flow in 2012. That is more than the market cap. So we are trading at a less than 1 multiple on our owners' earnings for free cash flow. As we saw, it was 300 million in valuation, and now we're looking at 471 million in owners' earnings. That just doesn't seem right, and there's got to be something wrong here. So let's go through this and see how the free cash flow would work out. So this is just the untouched spreadsheet on what they give as the fair value. Today it's trading at $12.86. Fair value, given the default metrics that are in here, 25.3% growth, 9% discount rate, 3% terminal rate, and 104 million in free cash flow. We put that math in there. We had a fair value of $211.42. We are at a 94% margin of safety. This would be, if we were to hit this fair value, if these calculations were correct and we were to hit this fair value, we'd have a 20-bagger in Peter Lynch parlance. That just can't be. That doesn't seem right. There's got to be something weird going on. Why would the market price something this ridiculously cheap in this market? We'll talk about that in part 3.